Have you ever, stopped to think about how much trust we put into these invisible systems all around us? I mean, think about tapping your card for coffee or getting packages delivered from halfway across the world. We just sort of assume it all works accurately, right? Well, today we're doing a deep dive into one of the most fundamental structures behind that trust, the COSO internal control framework. Our mission here is really to demystify this thing, to pull back the curtain on the controls that keep organizations reliable, accurate, and, compliant. And this isn't just jargon for accountants. It's truly about understanding how organizations build and maintain their integrity.
Yeah, absolutely. And getting that understanding, it really does give you this unique kind of behind the curtain peek. You start to see how really solid companies operate, how they build that confidence, and it all comes down to having a strong foundation of internal control.
Okay, so let's unpack this right from the absolute basics. What is internal control?
Well, at its heart, it's pretty straightforward. It's basically any policy or procedure an organization uses to help achieve its goals.
Like safeguards almost.
Exactly. Safeguards to make sure things run the way management intends them to. And there are really three main objectives that, pretty much every entity is aiming for with these controls. First, and this is the one people probably think of most with company reliability, is the reliability of financial reporting.
Making sure the numbers are right.
Precisely. Making sure they're trustworthy for investors, regulators, everyone. Second objective is effectiveness and efficiency of operations.
So how well the business actually runs day to day, like production lines, customer service, that kind of thing.
Yeah, exactly that. And the third one is compliance with applicable laws and regulations, basically making sure the company plays by the rules.
Okay, got it. Reliability, operations, compliance.
That's it. And even if you're an auditor who isn't specifically testing every single one of those operational controls, you still have to understand the whole system.
Why is that?
Because it's absolutely crucial for figuring out the risk. The risk that the financial statements might be materially misstated, you need that context. And sometimes controls around operations or compliance do directly impact the audit. Think about non-financial data you might use for analysis, or maybe non-compliance that could lead to huge fines showing up on the financials.
Right, it was all interconnected. So who actually came up with this framework? Who are the architects here?
That would be COSO, the Committee of Sponsoring Organizations. It's an independent private sector group. They were actually set up back in the mid-1980s, and their initial focus was specifically on studying fraudulent financial reporting, what causes it, how to prevent it.
And who sponsored them? You said sponsoring organizations.
Yeah, it was a coalition of the 5 major financial professional associations in the U.S. You got the American Accounting Association, TRIA, the AICPA, Financial Executives International, FEI, the Institute of Internal Auditors, IA, and the Institute of Management Accountants, IMA. Basically all the heavy hitters in finance and accounting.
Okay, so they carry some weight.
Definitely. They first put out their big internal control integrated framework back in 1992. But then, fast forward to 2013, and it got a really significant update.
Why the update? What changed?
Well, think about how much the world changed between 92 and 2013. Technology exploded, business models completely shifted, globalization took off, outsourcing became huge, and the whole regulatory landscape changed too. The 2013 update was needed to keep the framework relevant. And maybe the biggest change was formalizing 17 fundamental concepts into principles. These are now grouped within 5 main components, which we'll definitely get into. It really shifted the focus towards using judgment, not just following rules blindly.
That makes sense. And I understand there are other frameworks out there, but COSO seems to be the go-to standard, especially for financial reporting controls.
It really is. It's widely seen as, an appropriate and comprehensive way to document how you're assessing internal controls over financial reporting.
So what's the core purpose then? What's it trying to achieve?
It's got a few layers. First, it genuinely helps management and boards understand what an effective system looks like. And importantly, when controls are actually being applied properly day to day. Second, it gives confidence to outsiders, investors, lenders, customers that the organization has its act together, control-wise. But, and this is important, you have to remember its limitations.
Right, it's not foolproof.
Exactly. You've always got the potential for human error, simple mistakes. Or, more deliberately, management overrides someone intentionally bypassing a control. And here is a really key thing to grasp, kind of a pass-key idea. Real effectiveness isn't just about having policies written down. It truly requires management judgment.
Judgment in what sense?
Judgment in deciding if the controls are actually enough, if they're being applied the right way, and then assessing the overall effectiveness of the entire system. That principles-based approach in the 2013 update really supports and emphasizes this need for judgment.
Okay, that's a crucial distinction. And to help visualize all this, they use something called the COSO cube, right?
They do. It's actually a pretty clever visual, helps you see how all the pieces fit.
So break it down for us. What are the dimensions of this cube?
Okay, imagine a cube. Across the top face, you've got the three objectives we talked about, the columns: operations, reporting, and compliance.
Got it. Objectives on top.
Then, down the front face, you have the 5 integrated internal control components, the rows. We'll dive into those in detail shortly.
Okay. Objectives, components. What's the third dimension?
The third dimension represents the entity's organizational structure. This shows that the framework can apply at the whole entity level, or just to a specific division, or an operating unit, or even down to a specific function like, say, the accounts payable department.
Ah, so it shows how controls need to work across different objectives in different parts of the company.
Precisely. It highlights that dynamic relationship. Controls aren't just isolated things. They need to be integrated across the board, all objectives, all parts of the organization to really work.
Okay, that cube visual is actually helpful. So we've set the stage. Now, let's get into those 5 components you mentioned, the rows on the cube. You said there's a mnemonic.
There is, and it's a really useful one: crime.
Crime. Okay. Intriguing. What does it stand for?
All right, C is for control environment. R is for risk assessment. I is for information and communication. M is for monitoring activities. And E is for existing control activities.
CRIME. Control environment, risk assessment, information and communication, monitoring existing control activities.
Got it. And these 5, along with those 17 principles we mentioned earlier, are what you need to achieve those 3 objectives: reliability, efficiency, compliance. And think about how they integrate. Like, if your control environment, the tone at the top is weak, well, even the best control activities might not matter much. It's like building on shaky ground.
Right, the foundation has to be strong. Okay, let's dive into each one. Start with C, control environment. The tone at the top, what does that really mean?
It's exactly what it sounds like. It sets the overall tone of the organization. It influences how everybody from the top down views and acts on controls. It provides the discipline, the structure. It's the bedrock.
And who sets that tone?
It comes directly from management and, crucially, those charged with governance, like the board of directors. These are often what we call indirect controls because they influence the effectiveness of everything else.
So when an auditor looks at the control environment, what are they looking for specifically?
They're trying to understand things like, does management demonstrate a real commitment to ethics and integrity? Is there effective oversight from the board? Are authority and responsibility clearly defined? Does the company try to attract and keep competent people? And are people actually held accountable for their control responsibilities? Essentially, they're asking, is there a culture of honesty here? Does this environment actually support the other controls? And increasingly, how does IT fit into this environment?
You mentioned those charged with governance, the board, for example. What's their specific role in the control environment? It sounds pretty critical.
Oh, it's absolutely crucial. They're the ones who oversee and challenge management. They oversee the whole financial reporting process, make sure management isn't facing undue pressure that might compromise reporting, oversee things like whistleblower hotlines, and review how effective the whole control system is. Some of the key principles within the control environment component focus directly on this: commitment to ethics, board independence, and oversight, setting the right organizational structure, commitment to competence, and enforcing accountability. It all flows from the top.
Okay, so the tone at the top sets the stage. But companies always face risks.
Right.
Things that could go wrong. That brings us to our risk assessment. Is this the auditor assessing risk?
Good question. No, this is management's process for identifying and analyzing risks. Specifically, risks that could stop the company from achieving its objectives. It's about management looking ahead and figuring out what dangers are out there.
So what kind of risks are we talking about, especially for financial reporting?
Well, think about anything that could mess up the ability to initiate, authorize, record, process, or report financial data correctly. This could be internal things, external things. Even considering the IT organization is vital here. What are the risks associated with the technology they rely on?
Can you give some examples of when risks might pop up?
Sure. Risks often arise when things change, like changes in regulations or how the company operates, getting new senior personnel, implementing a major new IT system, or maybe dealing with new ESG issues, environmental, social, governance things, rapid growth, launching new business models, restructuring the company, expanding overseas, adopting new accounting rules.
Mhm.
All these can create new risks.
Wow. Okay, so management identifies these risks. Then what?
Then they have to decide what to do about them. Do they implement controls to mitigate the risk? Do they just accept the risk? Maybe because controlling it is too costly. The point is, they need a process to analyze and respond.
And what's the auditor's angle on management's risk assessment?
The auditor looks at it and thinks, okay, has management identified the significant business risks that could actually lead to a material misstatement in the financials? And, importantly, what does it mean if management missed a big risk? That could signal a weakness in this whole component. And specifically related to IT, the auditor evaluates risks like, is the company relying on systems that might be processing data inaccurately? Is there a risk of unauthorized access or changes to data or systems? Are they failing to make necessary updates? Is there too much risky manual intervention? Or could they potentially lose data?
Makes sense. So risk assessment is about anticipating problems. What about
Okay.
the Iantura crime, information and communication?
This component is all about making sure the right information gets identified, captured, and exchanged effectively and on time. Think of it like the company's nervous system.
How does that apply to financial reporting specifically?
Well, the information systems part focuses on how transactions actually flow through the company. How are they initiated, recorded, processed? How are errors corrected? How are system overrides or bypasses handled? How does information get summarized into the general ledger? It also covers how non-transactional information gets processed, things like depreciation estimates or asset valuations. And critically, how does the system ensure all the necessary information for the financial statement disclosures gets captured and reported correctly?
So that's the information part. What are the communication systems?
Communication is about making sure everyone understands their role and responsibilities regarding internal control. This isn't just formal policy manuals, though those are part of it. It can be oral communication, like in meetings or training. And significantly, it can be demonstrated by management's actions communication by example.
So what does the auditor need to understand about communication?
They need to understand the methods the company uses for internal communication, how roles, responsibilities, and important financial reporting matters are communicated within the company, and also how the company communicates with external parties management, talking to the audit committee or the board, or communicating with regulators, for instance. So, summing up the auditor's focus on information and communication, they really want to grasp the flow, how transactions get handled from start to finish, the accounting records involved, the whole financial reporting process itself, and how the IT environment supports all of that.
Okay, that leads us to monitoring activities. Is this like management spying on employees?
Ah, no, not quite like that. Monitoring is the process the company uses to check on the quality of its own internal control performance over time. It's about asking, are our controls actually working the way we designed them to? And if not, taking action to fix them. It's the self-assessment and correction loop.
So it's management's job to not just set up controls, but keep an eye on them.
Absolutely. Management is responsible for establishing, maintaining, and monitoring controls. They need to make sure controls stay effective and get adapted when things change.
So what does an auditor look for when evaluating monitoring?
They look for evidence of ongoing evaluations, are controls being checked regularly as part of normal operations, and also separate evaluations may be periodic specific reviews or tests. They'll look at the company's internal audit function, if they have one, what does it do, what are its responsibilities. They also consider the sources of information used for monitoring. Is it just internal data, or are they using external feedback too, like customer complaints or comments from regulators? And of course, is the information they're using for monitoring reliable?
Right, and there are principles tied to this too.
Yes, the two key principles for monitoring are about conducting those ongoing and/or separate evaluations and ensuring that any control weaknesses or deficiencies found are communicated appropriately and promptly so they can be fixed.
Okay, that brings us to the last letter. E for existing control activities. These sound like the actual tangible things people do.
Exactly. These are the specific policies and procedures put in place to make sure management's directives get carried out and risks get addressed. These are the hands-on safeguards.
Okay, so what are some common examples? You mentioned another mnemonic.
I did. For remembering common types of control activities, think paid tips.
Paid tips. Okay, let's break that one down too. P.
P is for pre-numbering of documents. Think sequentially numbered invoices or checks. It helps ensure everything is recorded, completeness, and nothing is recorded twice, existence. Simple but effective.
Mhm.
A is for authorization and approval, making sure transactions are properly approved by someone with authority before the company commits resources, like getting a purchase order signed off. I is for independent checks to maintain asset accountability. This is about verification. Someone checking work done by someone else. Think bank reconciliations, comparing detailed records to control accounts, doing physical inventory counts, and comparing to the books. A second pair of eyes.
Mm.
D is for documentation. Creating and maintaining evidence of transactions. Good documentation provides an audit trail, shows who did what and when. T is for timely and appropriate financial performance reviews. This is about comparing actual results to expectations, budgets, forecasts, prior periods. It also involves comparing financial data to non-financial data, like your example of a sports team using attendance figures to check ticket revenue, reviewing specific reports like sales analyses or aging receivables.
Okay, next I.
I is for information processing controls. These are controls built into the IT systems or manual procedures around them. They ensure transactions processed are valid, authorized, complete, and accurate. Think automatic checks in software or procedures for verifying data entry. P is for physical or logical controls for safeguarding assets and information. This is about security. Physically, it's things like locked doors, safes, security guards. Logically, it's passwords, multi-factor authentication, access restrictions in software, firewalls, limiting access to valuable assets and sensitive data. It also includes periodically counting assets and comparing them to records.
And finally, S.
S is for segregation of duties. This one is incredibly important. It's about making sure no single person has control over incompatible tasks.
Incompatible tasks. Like what?
There's a mini mnemonic for this too. ARC, authorization, record keeping, and custody of related assets. You want to separate these duties.
Why is it so critical?
Because if one person can do all three, authorize a transaction, record it in the books, and have physical custody of the asset involved, they have the opportunity to potentially commit and conceal fraud or errors. For example, the person who approves payments shouldn't also be the one signing the checks and reconciling the bank account. This is just as vital, maybe even more complex, in IT environments. You need different people or groups handling things like granting system access, managing the databases, and running the programs.
Okay, paid tips and RRs. Lots of practical controls there. Does an auditor need to understand every single one a company uses?
Not necessarily every single one in minute detail, but they need to understand enough about the company's control activities to identify and assess the risks of material misstatement. They use their judgment to figure out which controls are most relevant to preventing or detecting and correcting those misstatements at the assertion level.
Right. So, stepping back, we've covered a lot of ground here with the COSO framework. CRIME, control environment, risk assessment, information and communication, monitoring, and existing control activities. It really provides a solid structure.
It does. It's a powerful way to think about, implement, and evaluate the controls that are just so vital for any organization wanting to be reliable, efficient, and compliant.
So what's the big takeaway for you, our listener? We've just walked through this pretty comprehensive COSO framework.
I think the key thing is that this isn't just some theoretical exercise for auditors. It's genuinely a blueprint for how healthy, trustworthy organizations operate. It really drives home the point that the trust we place in companies, especially in their financial reporting, isn't just based on hoping they do the right thing. It comes from having a well-designed, actively functioning, and constantly monitored system in place.
That's a great way to put it. So here's something to think about. Consider an organization you really trust. Could be your bank, maybe a charity you support, even an online retailer you use all the time. How might these COSO principles, that strong tone at the top, the way they assess risks, how information flows, how they monitor things, the specific controls they use, how might all that be working quietly behind the scenes to earn and keep your trust? And maybe flip that around. What could happen if even one piece of that crime framework starts to break down? It makes you realize how these ideas apply well beyond just finance, doesn't it?